Yeah. Hello. Welcome, everybody. Good afternoon for those of you who are joining us from Asia, Europe, and Africa, and good morning for everyone who is joining here from Americas. It's a pleasure for us to host you all and to invite you for this interesting discussion on the first MIGA event during COP26 conference. Today, we will be discussing how climate risks are now becoming an important part of political risk considerations. The event will be in the form of a presentation led by Moritz Niebe, MIGA's Manager for Economics and Risk. We'll also have some time for audience's questions after Moritz's presentation. My name is Sarvesh Suri, and I'll be moderating the event. I'm Director for Climate, Energy, Extractors, Financial and Capital Markets Operations at MIGA. Let's start with a short presentation about MIGA's background. Thank you. MIGA, or Multilateral Investment Guarantee Agency, is a part of the World Bank Group, and our overarching goals are to reduce poverty and increase shared prosperity. If we can go to the first slide in the presentation, please. We were established in 1988, over 33 years ago, to provide political risk insurance to foreign investors as they invest into developing countries. Since then, we have supported close to 1,000 projects across the globe. In the recent years, our business has ramped up significantly with a global portfolio of about $23 billion. This has more than doubled in the last 5 years. Today, we are a premier political risk insurance service provider for investors investing into emerging and developing economies. We offer two kinds of guarantees. First is political risk insurance to de-risk cross-border private sector investments from the following four risks: risks of expropriation, breach of contract, currency convertibility and transfer restriction, and war and civil disturbance. Collectively, these four risks cover all the key government risks that foreign investors face when they invest into developing economies. The second guarantee product is a full credit enhancement that we provide, covering 95% of principal and interest for government borrowings at sovereign, sub-sovereign, and SOE levels. This insurance is akin to comprehensive covers available from ECAs. We are now seeing how climate risks are impacting political risk of countries and regions. This analysis is very important, not only for the investors who want to understand the political risk in countries where they'd like to invest, but it is also important for countries themselves to understand how their political, economic, and social fabric may be impacted by climate change. So without further ado, let me now invite Moritz to share his thoughts and research on the topic with us. Moritz, over to you.
Thank you very much, Sarvesh, and thank you very much to all participants and members of the audience across the globe. If we could skip to the next slide, please. Thank you. As introduced by Sarvesh, the challenge of how to incorporate climate risks into overall assessment of political risks is indeed very topical. One thing that the COVID crisis has highlighted is that in today's interconnected world, a health crisis can very quickly turn into a global economic crisis, which in turn can quickly morph into political crises, especially in environments with little resilience to deal with unexpected challenges. The climate crisis is not at all dissimilar in this regard. During this session, we'll try to dissect how a systematic approach to understanding climate risks at the country level can be incorporated into the wider analysis of political risk. During this presentation, I would try to provide some additional context to start with. I will then lay out what can be considered a systematic climate risk framework to be applied to the analysis of political risk. We will then look more deeply at what type of transmission channels exist between specific climate risks and respective political risks, and how these materialize. Finally, we'll then look at a few examples of specific climate risk indicators, how in practice they correlate to political risks. All this will be before we close our session with a few concluding observations. If we could move to the next slide, please. So to start with, let's look a little more at the wider context of climate risk and their link to political risk. Next slide. We are, of course, all aware that the effects of climate change are increasingly being felt around the world, and climate change does affect each and every region and country of the world. We also know that the effects are not uniformly distributed, and we know that different countries have different levels of ability, capacity, and resources to deal with the effects of climate change. The consensus around the need to mitigate and adapt to climate change is slowly evolving as the losses to society from climate change are growing, and governments and societies are gradually raising their ambition, albeit at a different pace. Next slide, please. Now, MIGA has been active in the political risk insurance field for over 30 years, and drawing on our deep experience in the field, we have now made a lot of progress in systematizing the inclusion of climate risk into our political risk insurance analysis and ratings. The first step in deconstructing this broad issue is to divide climate risks into physical risks on the one hand, and into transition risks on the other hand, i.e. those longer term risks that are linked to the transition to a low carbon economy. For each of these two broad categories, or their respective subcategories, to the extent that one can further differentiate between, for example, acute physical risks and chronic physical risks, we can identify specific drivers and respective transmission channels. Identifying these transmission channels addresses the question of how is certain climate risks impacted political risk. The choice of drivers that we're looking to consistently analyze are based on our practical experience, looking back over 30 years, and based on recent academic literature. The availability of good data sets is key for systematic inclusion of these drivers. As indicated by Savesh earlier in his opening remarks, accounting for these risks is indeed crucial for our risk analysis, as the ratings derived from the underlying analysis directly impact the pricing of risk that we insure against. Now, as also mentioned earlier, the materialization of the same climate risk can affect different countries in different ways, depending on amplifying or mitigating factors, which can make it harder or easier from country to country to deal with specific risks or climate events and questions.
Moritz, it's Chris here. I have a question for you. Just going back to the previous slide, the climate risk considerations that you mentioned, are they going to be a new risk that you're adding to your existing political risk ratings, and that will therefore result in a wholesale re-rating of political risks?
Thank you. I think that's a very relevant question. In fact, we have implicitly, in some cases maybe intuitively, reflected the existence certainly of the most substantial climate risks in our ratings for a long time. It's not that we've been oblivious to this type of risks. For example, the chronic risk of rising sea levels has for a long time been a key consideration in the risk assessment, for example, of small island states. Or a different example would be the commodity price downside risk, which for a long time has been a key constraint to the political risk ratings of many hydrocarbon exporters. But what is new in the emerging approach is a more holistic and a more systematic consideration of a much broader range of climate indicators into the analysis. So to answer the second part of your question, do we expect a wholesale re-rating? No, we don't. We certainly don't do that. But as we progress in the analysis of climate risk, and as climate risks are evolving over time, we will certainly see impact on ratings in specific cases.
Great, thank you.
Thank you. If we could move to the next slide. Thank you. This slide illustrates a little bit the background work that we've done of late. We've reviewed 60 pieces of academic research in depth. 26 of those were focused on physical risks, 9 were focused on transition risks, 19 dealt with both types of risks, and a small number dealt with other related topics. Quite interestingly, to observe 55% of the material we reviewed is less than 2 years old. 30% were older than 5 years. So I think this shows that the topic certainly isn't new, but it has received a lot more attention also from the scientific research community over the more recent past. At the bottom of the slide, we see a couple of examples of the type of research we have been doing, illustrating the broad range of topics, of authors, of institutions engaged in the research and engaged in creating knowledge. And the key roles also being played by both qualitative research as well as quantitative research and the availability of quantitative resources. We can move to the next slide. So now let us look at what a simplified framework for the assessment of climate risk and the impact into political risk can look like. Next slide, please. So looking at this slide, let's begin with the broad range of climate change all the way to the left-hand side of this diagram. We can break down the climate risks into physical risks, which is the increased frequency and severity of extreme weather events, and transition risk, the risk that arises from the process of adjusting to a low carbon economy. In the third column, we see physical risks can be broken down further into acute risks, and that would be examples like heat waves, floods, and droughts, and chronic risks, more gradual risks of rising temperatures, rising sea levels, for example. Further down in that column, the transition risks in turn can be broken down further into policy and legal shifts, top-down imposed laws and regulations on the one hand, and on the other hand, into market and technology shifts, more bottom-up driven changes in consumer preferences or private sector-driven technological advancements and developments. Now, if we look at the next column, at the country level, there exists a range of risk amplifiers and moderators, economic factors, governance factors, or social factors, which can make it easier or more difficult for a country to deal with specific climate risks. These climate risks, amplified or mitigated, depending on the country context, then have different impacts on the different political risks we analyze and rate, namely, as Sarvesh mentioned earlier, the risks of war and civil disturbance, the risks of expropriation and or breach of contract, and the risk of currency and convertibility and transfer restrictions. Now, you see in the diagram here that the box under the heading transmission channels is left blank. So let us move to the next slide to look in more detail how the transmission channels actually get to work. Yeah, let's move to the next slide. Thank you. So here we have an example of an acute physical risk. Let's first take the example of heat waves and wildfires. Such events can lead to reduced production capacity as well as damage to physical assets. If those are widespread across the country, this can lead to tangible reduction in public revenue generation capacity. In particular, in a fiscally constrained environment to start with, this can lead to reduced ability to honor contractual payment obligations and thereby lead to a higher breach of contract risk. At the same time, if reduced public revenue generation is being compensated by reduced transfer and social spending and the corresponding rise in poverty, it can also increase the likelihood of conflict over scarce resources and thereby increase the war and civil disturbance risk. Similarly, a more immediate impact on living conditions, for example, prolonged drought and potential damage to capital stock and infrastructure, can lead to reduced access to credit and financial markets, which in turn can lead to an increase in failed businesses and likelihood. The reduced opportunity cost of conflict, if we want to call it that, can result in a higher war and civil disturbance risk. And a parallel effect, the reduced inflows of capital and possibly, if relevant, the reduced FX foreign currency revenues from exports can negatively impact the transfer restrictions and inconvertibility risk.
Hey, Morris, before you move on, I wanted to ask a question about the implications of this approach. Do we expect that incorporating climate change developments would only ever lead to a negative impact on our ratings? Or is there a possibility or certain cases in which climate transformation could actually have a positive impact on some of our country ratings?
Thank you. A certainly relevant question, which has come up in our rating committees at times for discussion. It is mostly the case that climate change impacts political risk in a negative way. But I think as you indicate, there are examples, and one can think of examples, where climate transition can actually can be beneficial to a country's political risk perception. One example would be in cases where a country has a comparative advantage in the production of green technology, for example, solar panels. This can translate into job creation, into transfer of skills, increase export revenues, with positive implications indeed for political risk ratings. Another example would be a country that has a lot of resources in in-demand green metals such as lithium or cobalt, which again, if successfully mined and exported, can lead to significant inflows of FX revenues and thereby support the overall fiscal situation in a country, its ability to provide services, and overall its ability to defend its exchange rate and enhance its transfer and convertibility risk rating, for example. So again, I think these examples are rare, but they certainly do exist. Thank you. If we could move to the next slide. Okay, so let us look now at a few examples of indicators that capture the impact of climate risk on political risk. We go to the next slide. So here we see a few examples of specific risk indicators for acute and chronic physical climate risk. For example, when wanting to look at extreme weather events and how to measure them, one can look at the ratio of damage from extreme weather as a percentage of GDP using the EMBAT database, which provides very detailed, significant data in this regard. Similarly, when trying to assess, for example, the relevance of rising sea levels and trying to measure this indicator for purpose of political risk assessment, one can look at the percentage of the population who live in areas with an elevation below 5 meters above sea level, using the World Development Indicators as a data source. Again, those are very extensive data sources covering countries across the globe. So those would be some examples. If we move to the next slide. So here we see an example of the correlation between specific risk and between a specific risk indicator and MIGA's internal political risk ratings. So in this specific case, we looked at the ND-GAIN vulnerability index to test how statistically significant it is in its ability to inform the respective political risk ratings. As you can see from the 3 graphs, the index has a pretty high correlation with all 3 rating categories, the highest correlation being displayed to the expropriation breach of contract rating, with a correlation coefficient of 0.52. For context, this is a strong correlation in sort of statistical analysis. It's not dissimilar from some non-climate related standard rating factors that we've been looking at for many years, such as governance effectiveness indicators, and it's actually higher in its predictive capacity than some of the very typical fiscal indicators, such as debt to GDP or fiscal deficit indicators. So we certainly found a very strong correlation in this regard.
Moritz, can I ask a question? I think on the use of the Notre Dame Gain Index, which includes both the measures of vulnerability as well as measures of resilience, is using such a broad structure appropriate for PRI rating?
Yeah, that's a very good question. When we looked at correlations and the statistical significance, we looked at different versions, different combinations, and tested them against our existing political risk ratings and to see what the predictive capacity and the correlation is. And we actually ended up in this particular case to take out the resilience component, the readiness component, which created a stronger correlation, a stronger predictive power. But also methodologically, we realized that what is measured in the readiness component and the resilience component is actually things that we already incorporate elsewhere within our analysis, such as basic economic factors, which are at the end of the day amplifying and mitigating factors. So it's important, I think, when we look at climate risks to always ask ourselves more questions, whether we actually ask the right questions, whether we cover the right areas. Thank you.
Thank you.
Okay, if we move to the next slide, please. Okay, so this is an example where things might not be quite as intuitive as we anticipated. I think the MDB indicators, as we discussed in the previous slide, showed us confirmed, the analysis confirmed our assumptions. It's not always as straightforward, and there's always a wider context at work. So sometimes we do observe weak correlations where we would have expected higher ones, and we need to ask ourselves what are the potentially mitigating factors that cause a lower than expected correlation.
Hi, Moritz, can I ask a quick question?
Yes, please.
On this slide, could you talk a little bit more about what the kind of other amplifying or mitigating factors might influence the correlation between the climate risk and political risks?
Yeah, thank you. So what we actually see on this slide here, we try to test for the statistical correlation between transition risks and political risk ratings. And our starting assumption was that a high degree of transition risk should be somewhat positively correlated with a higher degree of political risk. So what we did, we used the carbon intensity of the economy, measured as the ratio of GHG emissions as a percentage of the total size of the economy, as a proxy for transition risk, on the premise that the higher the carbon intensity, the higher the fiscal cost during the transition period to decarbonize the economy, and hence the high fiscal cost translating into higher political risk. However, we did run the statistical analysis. We saw that not only is there no strong positive correlation, contrary to our expectations, we actually saw a slightly negative correlation here. So here, after we thought about this in more depth, it actually became quite clear to us that in most cases, a high level of GHG emissions occurs in the more developed economies, which tend to be more resilient, richer, better developed, have better governance structures in place to deal with the effects of climate change. So essentially, even though we measured GHG emissions to GDP, in a way we measured the level of development of the economy. And that explains the negative correlation. The more developed an economy is, the less impacted are political risk ratings by this. So this is an example of what I tried to explain earlier. Really, one always has to ask these additional questions and not always be satisfied with easy answers, because there's so many factors really playing together. If we look at the next slide. Yes, thank you, Chris. If we look at the next slide. So here we see a few more examples of the different kinds of amplifiers and mitigators for climate risk. The economic indicators really signal the country's ability to deal with climate change from a fiscal perspective. The institutional indicators stand for the country's capacity to implement the appropriate long-term policies and actions. And the social indicators help understand how certain climate risks may be amplified by specific demographic country context. So those are just a few examples of the type of country-specific, country context-specific characteristics one always needs to look at. If we go to the next slide. So at this point, I'd like to conclude the presentation and finish just on a few forward-looking concluding remarks. I'm not going to summarize all I've said. but just three key observations. So I hope the presentation has put some structure around the complexities of incorporating climate risk into the analysis that underpins political risk ratings. First observation at this point, the understanding of the impact of climate change remains a field of tremendous amount of ongoing research, and data is being produced at a very fast rate. Availability and quality of data is still patchy at times though. And as data volume grows, it is imperative to keep selecting the right, ideally complete and high quality data for purposes of assessing the impact of climate risk on political risk. Secondly, quantitative and qualitative research on transmission channels is ongoing. New findings will have to be assessed and incorporated into relevant risk assessment frameworks on an ongoing basis. And lastly, methodologies will need to constantly evolve and adapt as new research becomes available. As we said at the outset, accurate political risk insurance ratings are critical for the correct pricing of political risk, and accounting for climate risk will remain a key feature going forward. I'd like to thank all of you for your attention and interest. I'd like to thank my fellow discussants, and at this point, we'd be happy to take questions from the audience.
Thank you so much, Moritz, for a very interesting and informative discussion. And thank you also to the other participants for asking questions. I see that so far online, there aren't any questions that have been asked. So let me go back to the panelists. If you have any follow-on questions for Moritz.
Go ahead, I have a follow-up question, if I may. And this is just bringing it down to perhaps a more granular level. And when you talk about a specific project, let's say, so for example, if there's a power project, let's say a wind energy project, as of today, how would you go about assessing the climate risks associated with that kind of project? You know, would you be looking at the particular location? Is it in an earthquake? A vulnerable area, and would there be certain mitigations that you would incorporate into your analysis? I'd be very interested if you could talk a little bit more about that. Thank you.
Thank you. I will give my my thoughts around that. I would also ask Mina Kamet to potentially come in with any additional thoughts after me. So I think two things to consider. One is the physical risks, and indeed is the location, for example, located in an area that is prone to physical risks like wildfires, like landslides. Does it sit sort of in a watershed area, prone to flooding, etc. So those would be some obvious questions to ask around the physical risks. Now, there might also be very relevant questions looking at the longer term transition risks. So if you look at the renewable power project, what is, for example, the wider expectation for the energy sector in that country to develop over time? What is the expectation of other competing renewable energy coming into the country, potentially at better economic terms from the host country's perspective? And is this something that over the long term could, for example, impact the breach of contract rating? Is maybe the commercial consideration around the project 5 or 10 years down the line no longer as compelling as it is today from the host country's perspective, and might this reduce the willingness, for example, to honor contractual obligations of a power purchase agreement over a 25-year period? That would be my initial thoughts. Mina, I don't know if you would like to add any specific thoughts to this.
Sure, I would say I agree with what you said about assessing the climate risk of a specific project, but one other lens that I wanted to add is the assessment of the extent to which climate risk is a driver of the project we're looking at, because that can affect the risk, but also the development impact, which is important for us. So for example, we recently closed a wind power project in Djibouti and thought about it as that's a country that's extremely arid, one of the most arid in the world, where climate transition as well as competition for resources is a key driver of political risk from our perspective. And in addition, energy security, which is also a potential risk issue, is at risk in Djibouti because it relies on hydropower from Ethiopia, where the water resources are becoming increasingly variable and scarce as a result of climate change in the country. And so there's a lot of ways in which climate change and climate risk touches our project, and we like to look at it in a holistic way.
Thank you, Moritz and Mena. Let me also invite Yasser to come and talk a bit about it, because this element of looking at climate risk in every project that we support is also a part of the new climate change action plan that our board just approved. And as you know, as we look at Paris alignment for all the projects going forward, that needs to meet the criteria both on the mitigation side, but also an adaptation side. So let me invite Yasser Ibrahim, who's MIGA's Sector Manager for Environment, Social Risk, as well as Climate Risk, to come in and comment on this.
Thank you, Sarvesh. And I think this is a very interesting point that you've raised. I think, as you said, our board approved the Climate Change Action Plan for the World Bank Group, where we do have some commitments around incorporation of climate risk in our analysis. And as we've heard today from Moritz, how climate risk is important to be incorporated in the political risk insurance modeling, as well as the pricing. On the other side of the sustainability and our work with our partners and our clients, we have been including climate risk in all our assessments now for real sector projects, where we try to understand, as Moritz said, the physical risks, the transition risks, but then how can we work with our clients to mitigate those risks? And I think this is an important thing where there are risks for projects, but there are also opportunities. And the key is how can we work with our partners to identify the risks, mitigate those risks, but also identify opportunities and see what we can do to work with our clients so that we can amplify these opportunities more. So I think this is the thing where when we've been seeing working with clients, understanding climate risk vulnerability is now a key thing. And clients didn't have the models or the data that Moritz said was not available at the time of business development. And now we've been working with clients to go through these data and explain what are the vulnerabilities of projects and how can we mitigate those vulnerabilities going forward. So the work around climate risk has been growing over the past couple of years very much. And as you said, going forward, we will be incorporating all that in our Paris alignment methods and analysis. Hope that answered it.
Thank you. Thanks a lot, Yasser. And maybe I see that there's no questions yet on the online. Let me ask you a question, Moritz. We've seen a bit of a downward trend in political risk ratings over the last 18 months. Due to COVID, the countries are becoming more and more indebted. The public indebtedness is going up. Also, as we are seeing in several countries, the fragility has increased. So have you seen that this impact our ability to offer political risk coverage, where the clients are asking us to provide them coverage to be able to continue to invest in emerging markets?
Thank you. I'll give my initial thoughts and would then like to pass the question also on to Chris from our operations department. I think there's two factors at work and clearly over the past 18 months during the COVID crisis, political risk insurance ratings have suffered across regions for many countries. The factors at work, on the one hand, as political risk increases, one expects there to be more demand for political risk insurance. On the other hand, in particular on the greenfield investments, we've certainly seen a degree of reluctance to make long-term commitments by investors to new projects. And then obviously the pricing for political risk insurance changes as political risk ratings deteriorate. So those are three kind of developments pulling into, at times, opposite directions. But I would like to pass the question on to Chris. Thank you.
Thanks, Moritz. Yes, no, I would say that certainly when COVID struck, a lot of projects were delayed. They weren't necessarily cancelled, but they were delayed. And as Moritz mentions, perversely, with a decrease in ratings, that does increase the value of political risk insurance. So during this whole period with COVID and a lot of other pressures on the global economy, the kinds of conversations that we had with our clients have in fact become ever more intense. And although pricing does increase, the value of political risk insurance and the value of an entity such as MIGA does also increase. The final point that I would make to this is that obviously MIGA has quite a large portfolio of existing investments. And what we have seen is more interventions with existing projects and working with our clients and working with our member countries to try to work out the right solutions for projects that are ongoing. Thanks.
Thank you. So let's conclude this session here today. Thank you again for joining us. It's been a very interesting discussion as the world moved towards increased temperatures, hopefully with the concerted actions of the public sector, the private sector, all the stakeholders together in COP26 and elsewhere will move us towards a path of 1.5 degree increase by 2050. Even with that increase, in the best case scenario, as we have seen, the climatic risks will continue to increase. They will continue to impact political risks, just as Moritz went through his presentation. So we from MIGA, we are starting to incorporate this risk into our analysis to be able to offer the best advice, the best guidance for our clients, as well as the best service that we can provide to them. This is just a beginning of a discussion, and we hope to continue this discussion with you going forward. With that, thank you so much for joining. Have a good rest of the day and all the best.